Welcome and thanks for joining us for the Sharon Partners quarterly market update for the June quarter 2023, end of the financial year we've just been through, which is fantastic. I'm Kim, one of the advisors here at Sharon Partners, and as always I'm joined by Dr. Steve Garth, who sits on our investment committee. Steve, thanks for joining us.
Yeah, thanks Kim, great to be here.
So Steve, we're fresh into July, we've got through the end of the financial year. It seems like we've had a really great start to the year for 2023. What can you tell us about the Australian markets?
Yeah, let's start there Kim, and you're absolutely right, it's been a cracking first half. To be honest, the last quarter has been a little bit flat, but the first quarter was sensational, and you can see that overall the market's up 4.4% for the first half, but even better, it's up by 14.4% for the whole 12-month period. Now, on top of that, Kim, we're showing in this chart here that the volatility is really low. It hasn't been this low since 2021. So we've got a combination of markets going up and low volatility.
That definitely keeps people very happy.
It does, it does.
And Steve, what about the international markets?
Well, if you thought Australia was doing well, international markets are doing really, really well. Have a look here at the developed markets. So this is ex-Australia, and you can see they're up 17.5%. Now, the biggest country in the developed markets is the US. They're about 65%, and you can see they're having a cracking first half of the year. But other markets too, Europe, who would have thunk? There's a war going on there, but Europe's up. And Japan, where normally nothing ever happens, they're having a really good first half too. So in general, markets are up in the developed markets, particularly the US. If we go to the emerging markets, not really happening there, and that's because China is the biggest bit of the emerging markets. And at this point, even though China's out of their COVID lockdowns, that economy hasn't really kicked off the way many commentators thought it would. So that's a drag on the emerging market returns.
And Steve, you mentioned that the US has performed really, really well. What can you tell us more specifically about that?
Yeah, why don't we just look a bit more deeply into the US market for a moment. I think most people have heard of the S&P 500, the big index. Well, it's made up of stocks from two different exchanges. One exchange is the New York Stock Exchange. That's where about 54% of the stocks come from. But the other 46% of stocks come from something called the NASDAQ, which I'm sure people have heard of. That's where the big tech stocks live. And you can see in this chart the difference between the New York Stock Exchange, which is kind of just bubbling along, much the same return as Australia, but the big tech stocks in the NASDAQ, wow, that's up 30%. Now the thing is, Kim, it's not all of the NASDAQ, it's like 7 big stocks, the top big stocks. They're called the Magnificent Seven, which is Apple, Microsoft, and a few others. But probably one that most Australians have never heard of a few weeks ago was called Nvidia, which is now the third largest stock on the US market, and it's up 180% this half year because they make chips, that is semiconductor chips, and everyone's got this craze about artificial intelligence, and you need the chips to drive the artificial intelligence.
But of course, you know, looking at that international performance, Steve, it really just does go to show the importance of participating in all of those markets at all times. And of course, our clients get that exposure to those areas through the international exposure in their portfolio. But now, change of tack, Steve. So the RBA met yesterday and opted not to increase rates, which I think had a lot of people cheering. What are we thinking in terms of future rate rises? Are we getting close to that terminal rate that we've been talking about?
You know, Kim, that's a great question. Of course, we don't know the answer, but we do have some insights into it when we look at bond yields. Now, I know that's not everyone's cup of tea, but you can see in the chart we've got here the way bond yields have been behaving over the last 12 months. And you'll note in the last 3 months, they've just been inching up a little bit more. Now, that's not great for bond returns. It's kind of been a very flat, slightly negative return for bonds in the quarter. But what it does mean is that these aren't skyrocketing up. It means we're getting very close to what they call the terminal rate. So we had a pause yesterday. It's possible there's another rate rise, maybe another 2 over the course of the year, but we're very, very close to the end of rate rises.
And Steve, it really has been a bit of a wild ride over the last few years, but there's a bit of a mixed bag there, but some really positive news coming out there. And again, some really great reminders that the important thing to do is really to maintain a very disciplined approach and to maintain that diversification to all of those different market sectors. So Steve, thanks for joining us again, and we look forward to catching up with you next quarter.
Terrific, thanks Kim.